Hello and welcome to another episode of Classroom. We're still analyzing the balance sheet impact and the impact on earnings. This time round, we're picking a specific issue that's been a niggling problem for the market. It hasn't come out so far in the financial year we've put behind us, but it could be something that becomes a bigger issue, particularly for many mid-cap companies. We're talking about FCCBs and why the market is worried about the impact on profitability for companies in the quarters to come. My two guests today, K. Raghavendra Rao of Orchid Chemicals and S. Ramesh of Kotak Securities. Gentlemen, good to have both of you on the show. Let's start from the start. Ramesh, what is an FCCB defined as?
An FCCB stands for a Foreign Currency Convertible Bond, which is issued by Indian companies, which has got characteristics of both a debt and an equity. It's primarily issued in the form of debt, but it's got inherent option given to the investor to convert these bonds to shares at predetermined share premium at the time of issuance. This is essentially a foreign currency instrument issued by Indian companies, and these are listed on one of the overseas exchanges like the Luxembourg, the Singapore or the London Stock Exchange.
If you had to pick a reason, Ramesh, because many of these FCCB decisions were taken in the bull market era, i.e. around 2007, why did companies or why do companies opt for FCCB via going the equity way or pure debt?
I think there are a number of reasons why this instrument found favor with a number of Indian companies, and even globally this is a popular instrument. What companies keep in mind is that if there is a feeling that the share price or the stock price of that company has upside and the current prevailing price probably doesn't capture the full fundamental value, since FCCBs are converted at a premium to current market prices, issuers look at that. Secondly, a number of Indian companies also have end use which are either foreign in nature, or they have got export earnings, which gives them a natural hedge when they borrow or issue this instrument in foreign currency. Thirdly, under the Indian guidelines so far, the minimum maturity is 5 years, so it is also perceived as a long-term instrument from an issuer point of view in the event it does not get converted to shares. So if you look at these few advantages that I talked about, that is why Indian companies prefer to take the FCCB route.
Raghavendra, bring in your own example as a corporate for that. Why is it that you chose to go the FCCB route?
It is really a very good instrument if you have a proper business plan for a 5-year period, because perhaps this is the only instrument which captures a part of the future value, because if you take a pure loan, obviously it is not capturing any future value, and if you take an equity route at the beginning, at the time when you have to take a decision on FCCB, it won't give you anything other than the market price. So this is one instrument which gives a premium to market price, and if your business plan is robust enough and if you realize the potential of the company over a 5-year period, the rate of growth of the company, if it is more than the premium that FCCB holders give the company, then it is beneficial for both, because they can convert that into equity. At the same time, company is actually trading on a forward situation and taking more money and issuing less number of shares compared to the equity route. So it is better for both the parties.
Ramesh, before I